It's a continuation of what's been incremental moves, but this past 7 days, has been monumental. Did you participate in the outflow? Have you taken money out of China, or was it just too late?
No, we didn't take money out of China, and no, we don't think it's too late or too early to be thinking about it. Look, China is a $14.7 trillion economy. It's growing at 2.3% year on year when you look at the GDP numbers. Valuations are reasonable, with forward PEs at times 12, and it's essentially now back in positive territory after this morning. So we are marginally overweight Chinese equities at the moment, despite Beijing's regulatory crackdown. We see that as short-term in nature. There's been some changes in the senior government positions, and they're making changes. And they've really focused on a whole range of sectors, particularly technology, as you've already highlighted, but real estate was hit hard, and the education sector in particular was hit hard too. But we see it as short-term. And remember, China's way ahead of the rest of the developed countries in this world in terms of bringing the COVID-19 pandemic under control. It's largely avoided all the follow-on waves. The currency markets have been reasonably stable. You've seen yuan strength at around 6.5. We're more inclined to see inflows rather than outflows, medium to longer term. But we are cautious short term, without a doubt. Obviously, the heightened regulation is a concern that we have to stay focused on. The stronger yuan obviously has an impact. And of course, there's resurging political tension with the Biden administration too. But remember, China is a domestic growth story, and that's what we remain focused on. And that story is still robust.
So then my guest in the last hour talked about trying to, I suppose, not protect yourself, but trying to focus on China Air shares, which plays to your theme, which is about it's a domestic play. It's a domestic play with global consequences. He's going for renewables, new vehicles, domestic consumption, and new infrastructure. A shares onshore versus political, social, and geopolitical risk offshore.
There is definitely a focus towards those sectors at our end too, Manus, but we do want global growth exposure. And China, coupled with Japan and the rest of Asia, are very significant players in that regard. And you'd be unwise not to have broad exposure when it comes to China, Japan and Asia, which are intrinsically linked to China in the way things are going. China is still growing. You know, this is often forgotten. When you actually look at the US, GDP growth is minus 3.5%. When you look at Europe, GDP growth is minus 5.9%. We're at plus 2.3% here. China continues to grow, and it's a $14 trillion economy. It is bigger than Europe and Japan added together by quite some margin. So that's what investors have to stay focused on. A lot of this is short-term noise. A lot of this is politics. It is having an impact on earnings. It is having an impact on relations with Europe and the US, but we see it as short-term in nature. We're long-term investors, Manus. Stay focused on the long-term story here.